We're revisiting some timeless self-help principles.
Okay.
And we're going to see how they hold up in 2024.
Sounds good.
We'll be drawing on two really interesting books, James Clear's Atomic Habits and Benjamin Graham's classic, The Intelligent Investor.
Oh, nice pairing.
Yeah. One is all about tiny changes that lead to big results over time.
Right.
And the other is a deep dive into smart investing.
I like it. They might seem like very different worlds, you know?
Yeah.
Atomic Habits and The Intelligent Investor.
Right.
But they both really stress the importance of consistency. And really understanding the systems that we're working in, whether that's like, you know, our own personal habits or the forces that are moving the markets.
It's like the tortoise and the hare. Lowen said he wins the race.
Exactly.
So let's start with James Clear in Atomic Habits.
Oh, okay.
He's all about how small changes can compound over time.
Right.
Kind of like compound interest, but for our skills and knowledge.
Yeah, that's a great analogy.
Yeah. And ultimately, that's what leads to success.
It is. And you know what? That's actually what Warren Buffett says about building knowledge.
Oh, really?
He's got this famous quote, "That's how knowledge works. It builds up like compound interest." It's pretty powerful when you think about it.
Yeah.
Like every book you read, every skill you pick up, every new bit of information you learn.
It all adds up.
It's all adding to that knowledge base and compounding over time.
So it's not about getting rich quick.
No.
It's about building something for the long haul.
Right.
Which takes patience.
Yes, it does.
And speaking of patience, Clear talks about this idea of the valley of disappointment. That's that phase where you're putting in the work, but you're not seeing the results yet.
Right.
And it's so easy to get discouraged and give up.
It is. It's so tempting to just throw in the towel, you know?
Yeah.
But the thing is, recognizing that it's a natural part of the process is huge.
Okay.
Instead of getting demoralized by that plateau, think of it as a sign you're on the right path.
Like it's always darkest before the dawn.
Exactly. You just got to keep going.
So it's about resilience and grit, that stick-to-itness.
Absolutely.
It's what separates the people who achieve their goals from those who don't.
I think that's a great way to put it.
And Clear doesn't just talk about individual habits.
Oh, no.
He actually questions the whole idea of being goal-oriented.
Interesting.
He says that just focusing on goals can actually make us less happy.
Oh, how so?
Well, it creates this all-or-nothing scenario.
Okay.
You either achieve the goal and you feel successful, or you don't and you feel like a failure.
I see. So what does he suggest instead of focusing on that end goal?
Well, he says we should focus on building systems.
Okay.
He says lasting success comes from having the right systems in place,
Right.
not just chasing some specific outcome.
Interesting.
And he has this really powerful analogy to illustrate it.
Okay, let's hear it.
He says, you do not rise to the level of your goals. You fall to the level of your systems.
I like that. Break that down for me. What does it mean to fall to the level of our systems?
Well, think of it this way. If you have a system for managing your money,
Okay.
like even just putting a little aside each week,
Yeah.
you're much more likely to build wealth over time,
Right.
regardless of whether you hit some specific savings goal by a certain date.
It's the consistency of that system that really makes the difference.
Exactly. It's like having financial autopilot.
Yes.
It works for you even when you're not thinking about it.
Love it.
So systems are key.
Okay.
But how do we actually build these powerful systems, especially when it comes to finances?
That's where understanding the habit loop comes in.
Okay.
Clear breaks it down into 4 stages.
Right.
Cue, craving, response, and reward.
Okay.
And let me give you a financial example.
Okay.
Say you get a notification about a sale on something you've been wanting.
Oh, I know those.
That notification is the cue.
Okay.
It triggers a craving, that desire to buy it.
That feeling of, ooh, a good deal.
Exactly. And the response is actually buying it.
Right.
And the reward is that feeling of satisfaction when it shows up.
Oh, I know that feeling too well.
But if we're trying to be more financially savvy, understanding this loop can really help us make smarter choices.
Okay. How so?
It all starts with awareness.
Right.
When you recognize this loop happening,
Yeah.
you can stop and ask yourself some questions before you whip out your wallet.
Like what kinds of questions?
Well, do I really need this?
Okay.
Does it fit into my financial goals? Or am I just falling for a clever marketing trick?
So it's about being more mindful about our spending habits. It's not just letting our impulses control our finances.
Exactly. It's about being in the driver's seat.
I like it.
You know, one thing that really stuck with me from Atomic Habits was Clear's point about self-control.
Oh, what about it?
He says it's a short-term strategy, not a long-term solution.
Right.
He suggests shaping our environment to support good habits instead of just relying on willpower.
That makes sense.
He talks about making cues for good habits obvious and making cues for bad habits invisible.
So like unsubscribing from all those tempting email lists.
Exactly. Those ones that are always trying to get you to buy things you don't need.
Yeah, those are dangerous.
And you can also automate your savings, you know?
Oh, right. So the money just goes straight to savings.
Yes. You don't even have to think about it.
Out of sight, out of mind, right?
Exactly. Right into your savings account.
I love it.
And here's another simple but effective one.
Yeah.
Keep those credit cards out of sight.
Oh, good point.
If they're not staring you in the face, you're less likely to impulse buy.
It's all about removing those temptations.
Exactly.
Okay, so we've covered a lot with Atomic Habits.
We have.
But we've got another brilliant author to bring into the mix.
Oh, who's that?
Benjamin Graham and his book, The Intelligent Investor.
Oh, a classic.
It's amazing how relevant it still is.
It really is.
He wrote it way back in the mid-20th century.
Wow.
But his insights on market fluctuations and investor psychology are just as true today.
You know, he really understood how investors get caught up in those market ups and downs.
Yeah.
They focus so much on those fluctuating prices.
Right.
They forget they're actually buying parts of businesses.
It's like they're more focused on the score than the actual game.
Exactly. Graham reminds us those stock prices can be way off from a company's real value. He encourages us to think long term.
Okay.
And not get distracted by all the noise of short-term market movements.
Easier said than done, though, right?
It is. It takes discipline.
Yeah. And a solid investment strategy.
Which is what Graham is all about.
Exactly. He wants us to be intelligent investors.
And, you know, Graham had some really interesting things to say about interest rates.
Okay.
And how they affect investment decisions. He pointed out how bond yields had become much more attractive compared to stock dividends at the time.
Interesting.
He even wondered if just sticking with bonds might be smarter.
Wow.
Until there was a better balance between bond returns and stock returns.
Now, it's important to remember he was writing during a very specific time.
Yeah.
But his point about carefully weighing different investments and their potential returns still holds true.
It does. He wasn't saying ditch stocks altogether.
Right.
But he was urging investors to be realistic and prepared for market ups and downs. So diversification is key.
Exactly. Don't put all your eggs in one basket.
And be prepared for the unexpected.
Absolutely. Even the best stocks can take a hit sometimes.
So we've got to be ready for those bumps in the road.
For sure. Another thing Graham warned about was speculation.
Right. Those get-rich-quick schemes.
Exactly. Chasing the latest trends.
He was a big believer in value investing. Buying undervalued assets and holding them for the long run.
Right.
He contrasted this with the whole buy low, sell high mentality that drives speculation.
Oh, I see.
He saw that when too many people try to jump on the same trend, it becomes less profitable.
It's like a law of diminishing returns.
Exactly. Like that old saying, if it sounds too good to be true, it probably is.
Exactly.
He actually pointed to this thing called the January effect.
Okay.
It's this phenomenon where small stocks tend to do well in January, but as more traders caught on and tried to exploit it, the effect became less and less.
So chasing easy money can backfire.
It often does.
Now, while Graham was cautious about speculation, he did have some strategies for finding undervalued stocks.
You did?
He called them bargain issues. These are stocks that are selling for less than a company's net working capital.
After all their debts are paid off.
Exactly.
So basically buying assets on sale.
Exactly.
Minimizing risk and maximizing potential for profit.
Right. And what's surprising is that Graham found these bargain issues were more common than you might think.
Interesting.
So there are deals to be found.
There are.
But you have to have the right mindset.
Absolutely. It's about shifting from that short-term speculative thinking to a more patient, value-oriented approach.
And another key element of Graham's approach is diversification.
Yes, crucial.
He recommended a balanced portfolio.
Okay.
And for someone prioritizing safety, he suggested at least 25% in stocks. And ideally, a 50-50 split between stocks and bonds.
Classic risk management strategy.
Yeah, spreading your investments across different areas.
Exactly.
So you're not vulnerable if one area takes a hit.
Don't put all your eggs in one basket.
But with so many investment options these days.
It's true. It can feel a little overwhelming.
How does the average person even begin to diversify?
It's a good question, but the good news is there are more resources than ever to help.
Like what?
Well, you could work with a financial advisor.
Oh,
they can give you personalized guidance.
Right.
Or you could explore online platforms.
Ah.
They have tools and resources to help you build a diversified portfolio.
Tailored to your own situation.
Exactly, your risk tolerance and investment goals.
So it's about finding the right support.
Yes.
To make those informed decisions.
Absolutely.
Now, we've talked a lot about the analytical side of investing.
We have.
But I think we need to come back to the human element.
Oh, for sure.
Investing can be emotional.
It can be a roller coaster.
And Graham knew how much market fluctuations could affect investors.
Yeah, he saw how people could get so fixated on those price quotes.
Right.
They'd lose sight of their role as business owners.
Right. They forget they're part of something bigger.
It's so easy to get caught up in that fear and greed. You start checking your portfolio every 5 minutes.
Right. Making impulsive decisions.
Based on those short-term changes.
So we become gamblers instead of investors.
Exactly. Reacting emotionally instead of thinking strategically.
Which is why Graham emphasized emotional discipline.
Absolutely. It's about sticking to your plan.
Right.
Trusting your research. Not letting those short-term market jitters throw you off course.
Keeping a cool head when things get heated.
Yes. Not getting caught up in the hype.
Good.
And not panicking when things dip.
Because those market fluctuations are normal.
They are a natural part of investing.
And those who ride the waves and stay focused on the long term.
They're often the ones who come out on top.
Okay, we've covered so much today.
We have.
From the power of atomic habits.
But Benjamin Graham's wisdom.
Before we wrap up this part of our deep dive,
Yeah.
What's one key takeaway you want our listeners to remember?
Well, I think the biggest thing is building wealth, especially these days.
Right.
Takes both practical strategies and the right mindset.
Okay.
It's about understanding those small actions.
Like atomic habits?
Exactly. And how they can build up over time.
Yeah.
But it's also about recognizing those bigger systems at play.
Like the habit loop or the forces that drive the market.
Exactly.
So being detail-oriented and seeing the big picture?
Yes. It's about being patient and persistent. And not letting setbacks knock you off course.
That's a great message, especially in a world obsessed with instant gratification and get-rich-quick schemes.
It is. It's about playing the long game.
Right.
Building those strong foundations. And not being afraid to seek out expert guidance.
Really great advice.
And it's about taking control of your financial destiny.
Yeah. Making choices that work for you.
Absolutely.
We've talked a lot about systems and strategies.
Right.
But I think mindset is just as important.
Oh, definitely.
I mean, investing isn't just about numbers, right?
No, it's about understanding ourselves.
Yeah, our psychology, our emotions.
That's where Napoleon Hill's Think and Grow Rich comes in.
Oh, yeah, a classic.
It really emphasizes the power of belief and desire.
Like his famous line, thoughts are things.
Exactly.
It sounds a little out there at first.
It does.
But when you think about it, it's kind of true.
It is. Our thoughts shape our reality.
Right.
If you believe you can achieve something, you're much more likely to take action to make it happen.
And if you doubt yourself,
you're
more likely to hold yourself back.
Exactly. Belief is a powerful force.
But how do we apply that to our finances?
Well, Hanischel tells this great story about Edwin C. Barnes.
Okay.
This guy who was determined to work with Thomas Edison.
Wow.
He had no connections, no resources, but he was so driven.
Yeah.
He overcame all these obstacles and achieved his goal.
It's about unwavering belief, right?
Exactly. And while we might not all want to be the next Edison, the point is a clear vision and strong desire can lead to incredible action.
So powerful.
It is.
Our minds can be our biggest asset.
Or our biggest obstacle.
Okay, let's go back to Benjamin Graham.
Right.
We talked about those bargain issues.
Right, those undervalued stocks.
He found that back in 1957, tons of companies were available at these bargain prices.
Wow.
And if you had bought one share of each and held them for just 2 years, the average gain was over 50%.
That's incredible.
I know, right?
Of course, markets have changed a lot since 1957.
Yeah.
But the principle still holds true.
Over 50% in 2 years.
I know.
That's pretty amazing.
It is.
But how do we find these hidden gems today?
Well, it takes some digging.
Okay.
Graham emphasized looking beyond the stock price and really understanding a company's financials.
Like their balance sheets.
Exactly. Their cash flow, their debt levels.
So we need to become financial detectives.
I like that.
Unearthing those undervalued companies.
With solid fundamentals.
It's not about chasing the latest hot stock tip.
No, it's about being an intelligent investor.
Right, being patient, disciplined, and not letting emotions rule.
Exactly. It's a blend of logic and emotional control.
Not exactly a recipe for a viral TikTok,
Probably not.
but a good approach to building wealth.
Yeah.
Now, Graham also talked about the difference between a defensive investor and an enterprising investor.
Right. Two different paths.
It's like choosing your own adventure in the world of investing.
Kind of, yeah.
The defensive investor prioritizes safety and stability.
Right. They're not looking to spend hours analyzing every detail.
Or taking big risks.
Exactly. They're happy to build a diversified portfolio
Of solid companies.
and let their investments grow over time.
So it's good for someone who wants to invest,
Yeah,
but doesn't want it to be a full-time job.
exactly. It's about building a foundation and letting time do its thing.
And then there's the enterprising investor.
Right. They're willing to put in more time and effort
To dig deeper and maybe take on more risk.
in pursuit of those higher returns.
They're the treasure hunters,
I like that.
looking for those hidden gems.
Yes, they're more active in managing their portfolios.
Always searching for opportunities.
Exactly.
It's amazing how Graham acknowledges that there's no one right way to invest.
It's about finding the approach that suits you.
Your personality goals and risk tolerance.
Absolutely.
And let's bring back that human element again.
Okay.
Remember how Graham talked about
Yeah.
how market fluctuations can affect our psychology?
Oh, for sure.
He saw how people could get so focused on those price quotes,
Right?
they forget they're actually business owners.
It's so easy to get swept up in those emotions.
Yeah, the fear and the greed.
You start checking your portfolio obsessively
Making impulsive decisions.
based on those short-term changes.
Like we're gamblers instead of investors.
Exactly.
Reacting emotionally, not strategically.
That's why emotional discipline is so important.
Right. Sticking to your plan.
Yes. Trusting your research.
And not letting those market jitters derail you.
Keep a cool head even when the market is hot.
Don't panic when things dip.
Market fluctuations are normal.
Yeah, they're just part of the game.
And remember, the people who can handle those ups and downs, who stay focused on the long term.
They're often the ones who succeed.
Yeah.
Okay, before we move on,
Yeah.
is there anything else from the intelligent investor that you think our listeners should know?
Yes, I think it's really important to highlight his advice on portfolio allocation.
Okay.
Especially for the defensive investor.
Right.
He recommended a balanced approach with at least 25% in stocks.
Okay.
And ideally a 50-50 split between stocks and bonds.
So a classic way to manage risk.
It is.
Not putting all your eggs in one basket.
Exactly. Creating a safety net for your investments.
So it's not just what you invest in,
Right.
but how you spread those investments around.
Exactly.
Now, I want to talk about diversification a bit more.
All right.
Such a fundamental principle.
It is.
And Graham was a big advocate for
Right.
it.
He really was.
He saw firsthand how market crashes
Yeah.
could wipe out even the best companies
That's why he stressed spreading your investments.
across different asset classes.
Not just stocks and bonds.
Right, real estate.
Commodities, even gold.
So diversify beyond the stock market.
Yes.
Create a portfolio that can handle anything.
Don't put all your eggs in one basket.
Right.
But it can be tough to know where to start.
With so many options,
It is. But there are resources to help.
like those online platforms and financial advisors.
Exactly.
Don't be afraid to get some expert advice
A good advisor can help you build a diversified portfolio.
that fits your needs.
Your risk tolerance, your goals.
And remember,
Yeah.
diversification isn't just about different asset classes.
Right.
It's about diversifying within those classes too. So diversify horizontally and vertically.
I like that.
For example,
Yeah.
if you're investing in stocks, don't just focus on one industry.
Spread your bets across different sectors.
Okay, to reduce your risk. Creating a balanced portfolio.
That can weather any storm.
Okay, I want to shift gears back to mindset.
Okay.
We talked about Hill's emphasis on belief, but there's another aspect that's really important for building wealth.
Are you talking about a growth mindset?
Exactly.
It's so important.
Believing you can learn and grow.
Yeah.
That you can develop new skills
Right.
and overcome challenges.
Seeing setbacks as opportunities to learn.
Yes, not as failure.
Embracing the journey, not just the destination.
And not being afraid to fail.
So important.
Because failure is often just a stepping stone to success.
I think that's a great way to put it.
It's about learning from our mistakes.
Right.
And adapting our approach.
Keep moving forward.
Because too often, fear of failure paralyzes us.
It does. It stops us from taking risks.
And pursuing our goals.
We need to see failure as a learning experience.
Part of the growth process.
Exactly.
Okay, As we move into the final part of our deep dive,
all right,
I want to bring everything together and give our listeners some practical takeaways.
Sounds good.
Okay, so we've talked about building systems and a long-term mindset.
Right, and diversifying our investments.
But what are some things people can actually do?
Yeah, like practical steps.
To start putting all this into practice?
I think a good place to start is just taking stock of your current situation.
Okay.
Where are you now financially?
Uh-huh.
And where do you want to be?
So figure out your starting point and your destination.
Exactly. Once you have a clear picture of those, you can start making a plan to bridge the gap.
Like if you don't know where you're going, any road will get you there.
Exactly. You need that destination in mind.
And once you have that,
yeah,
you can break the journey down into smaller steps.
Right. More manageable steps.
This is where those atomic habits come in.
Exactly.
Instead of getting overwhelmed by the big picture, we focus on those small, consistent actions.
Right. Because over time, those add up.
They compound and lead to big results.
It could be setting aside a little money each week.
Okay.
Or automating your bill payments.
So you don't miss any and get hit with late fees.
Exactly. Or maybe it's just reading one personal finance article a week.
Okay.
Or a chapter in a book.
It's about building those good financial habits.
Yes. That will change your whole relationship with money.
And it's not about being perfect, right?
No, not at all.
It's about progress.
Progress, not perfection.
And so if you slip up, don't beat yourself up.
Exactly. Just acknowledge it, learn from it.
Get back on track.
Building wealth is a journey.
It's a marathon, not a sprint.
Exactly. There will be bumps along the way.
But if you keep moving forward, you'll get there.
Keep learning and adapting.
And I think it's important to celebrate those small wins along the way.
Oh, absolutely.
They can be so motivating.
They give you that boost to keep going.
Maybe it's paying off a credit card.
Yeah.
Or hitting a savings goal.
Or just sticking to your budget for a whole month.
Whatever it is.
Take the time to acknowledge it.
Celebrate those wins.
And don't be afraid to share them with others.
Oh, good point.
Sometimes that accountability can really help.
Yeah, having people who support your goals.
It can make a big difference.
And remember, building wealth isn't just about money.
No, it's about so much more.
It's about creating a life you love.
A life of abundance and purpose.
Yeah, using your resources to make a difference.
To follow your passions.
And live according to your values.
It's about remembering money is a tool.
Yeah.
Use it wisely to create a life you're proud of.
But the main takeaway is this.
Yeah.
Building wealth is possible.
It's within your reach.
It starts with making a decision.
A commitment to taking charge of your financial future.
And then taking action.
One step at a time.
Remember that journey of 1,000 miles?
Yeah.
It starts with a single step.
So true.
So go out there, be those intelligent investors.
Yes.
Cultivate that growth mindset.
And remember,
true wealth isn't just about your bank account.
No, it's about the richness of your experiences.
The strength of your relationship.
And the positive impact you make on the world.